Hi, my name is Brian Bortz, and I'm one of the partners here at Cain Watters, and I'm also the chairman of our investment committee. And I am joined today by Brad Sanders, managing director of Tectonic Advisors. And this is your December 2025 and 2025 year-end investment update. For the month of December, stocks were kind of sluggish a little bit. S&P was up 0.1%. Global stocks were up 1%. Bonds kind of had a mixed bag. U.S. bonds were down 0.2%, and global bonds were up 0.3%. However, it really doesn't kind of tell the story for 2025, and we'll talk about that as we go through. But the S&P for the year was up almost 18%, 17.9%. Global stocks were up 22%. U.S. bonds were up 7.3%. And global bonds were up 8.2%. So Brad, I want to talk to you a little bit about kind of this mixed bag that we had. It was a heck of a year in the market, but kind of a sluggish ending to the year. I know it was really, the market was driven a lot by the tech stocks and the Mag 7. Alphabet or Google, for example, was up 66% for the year, basically. NVIDIA was up about 41% for the year. But there were also some stocks like Apple and Amazon that didn't do as well. The Mag 7 was up almost 28% for the year. But kind of what was going on a little bit on the tech sector, what happened as we wound down the end of the year, and tell me a little bit about kind of what you're thinking for 26.
Yeah, I think the AI bubble was in its full thrall, like in the summer and early fall. And really, the people, it feels like forever ago, but you had the Independence Day stuff in April, which was last year, believe it or not. It feels like it was like 5 years ago. And tech really got hurt really bad during that brief period where stocks fell. And then if you look at what tech did after that, it was up humongously, like even, it made it back all those losses. And then, as you said, the Mag 7 ended up 28%. But, I think the AI bubble has kind of reached its kind of apex here. It can go on for a long time, but you're starting to see narrative shifts, and you're starting to see people really question how these companies are going to continue to basically earn their way into their valuations. And if you look at Mag 7, like if you start looking at Google, their stock was up tremendously last year, but their growth rate is in its structural decline for the last 4 or 5 years, and that's just basically because it's a humongous company. You just can't grow. You can't grow 20% a year when you're a $2 or $3 trillion company. It's just really hard to do. You have to attract way too much capital. And if you start looking around the rest of the market, you started to see, the S&P was basically flat for November and December combined. But small caps were up, 5-6%, and you start looking at other, healthcare was up 25%, I think, from like August through September. So like defensive sectors are starting to catch a bid. And I think that's going to be the story for 2026 is just you're going to have the capital reformation in the market because these companies are too big. They just can't grow their way into the amount of capital they're commanding to continue to push their stock prices higher. And so I think that's going to be a little bit of the story is you're just going to have a broader market strength, which is really good for investors. You just can't have a market have 5 or 6 stocks drag it along for years and years on end. And that's going to benefit investors that are diversified. Diversification has been punished for the last several years, and I think, the next couple of years it's going to be rewarded. And that I think that's really where we're going to go from there. And on the bond side, I think we're going to get a couple rate cuts this year. I think the market's priced 2. I still think we'll get 3. I don't think we'll see another one until the spring. But credit spreads are at 25-year tights, but they can stay that way for a long time, and I think that's probably what they're going to do. So I think you're going to have a pretty healthy bond market as well in 2026.
Yeah, so we look on the bond market side. So with the Fed cutting rates like they had last year, so the short-term rates is what the Fed cuts, those came down.
Yeah.
But the long-term rates really didn't move that much, and people can see that kind of with mortgages and things like that. Longer-term rates really didn't move, so what you've ended up with is a little bit steeper curve.
Yeah.
So what does that mean as we go into 26?
It means a couple of things. You want to see a steeper yield curve, particularly if your economy is growing, and our economy appears to be heating up, and I think the administration would like to run the economy hot if they're able to pass everything they want to do. So that's a good thing. It means mortgage rates are going to be stickier, so housing affordability is going to be tougher. So you're going to see kind of some economic tension around stuff like that and around lower and middle class borrowers. On the corporate side, this is a really good thing because most smaller and medium sized businesses, and like all of our clients, have variable rate loans. When they get a practice run, they have floating rate loans. You're going to see those start to reset, and as we move into 2026, the small caps in the stock market are set up to where they're going to have year-over-year earnings growth starting with the fourth quarter of last year and into the first quarter this year. It's going to be in like a high teens versus large caps, which is looking like it's going to be in the high single digits. So you're going to have different parts of our stock market have tremendous baked-in earnings growth coming into this year, which is going to be fueled even further by lower interest rate and debt repayment cost as rates continue to come down. So I think money tends to go where the growth is, and I think when you start to look around the market, you have all this AI hype that's going to continue, but the real growth is in other areas, and those other areas are also where AI is probably going to first benefit, are going to be sectors that you might not, it's not going to benefit the tech sector first. It's going to benefit healthcare and industrials and all these companies that are kind of
They'll become more efficient.
way more efficient.
Exactly.
Just be able to suck costs out of their business structure. Yeah.
So I think if you're thinking about what's going to happen in 26, I think the risks to the market are that a lot of these big companies, these big tech companies in the Mag 7, have to prove their valuations through earnings, and that's going to be tough. So there's a little bit of a risk there. I think inflation's still going to hang around higher than the Fed wants, but a high 2% inflation, 2.8, 2.9, maybe tapping on 3%. It's not a horrible thing. I don't think it'll drag the market down.
As long as GDP stays where it is.
Exactly,
Yeah.
correct.
Yeah.
And then if you look at the outlook, I think there's probably a moderate growth of GDP for this year, and unemployment has stayed relatively low. So we're anticipating a pretty solid year this year, a little broader year than just focusing on a couple of stocks. And we look forward to getting back to you guys in about a month to let you know how January went. On a separate note, really quick, my partner Hunter Satterfield says hello. He couldn't make it today, but he'll be back for the January update. Until then, thanks.